So in this video today, we are going to be talking about how taxes are handled with the M1 Finance investing app. It's a question a lot of people have when it comes to investing, and I want to do my best here to answer some of the basics of what you should expect tax-wise when using this investing app. Now that being said, if you guys are looking to learn more about the basics of investing with M1 Finance, it is a really good investing platform, but it is a little bit complicated. I found I was getting a lot of questions from people, so I ended up putting together a 30-minute video training that walks you through step-by-step how to open an account with them, how to build a portfolio, what are pies, and how all of this works, and that is completely free. So I have that 30-minute training on M1 Finance linked up down in the description below if you guys decide that you want to check that out. But that being said, let's talk about taxes here with M1 Finance and what you should be expecting. And there is one thing you need to be aware of related to their rebalancing functionality of M1 Finance that could run into potentially a taxable event or situation. So right off the bat, just the basics of how taxes are handled with investing is you have both short-term capital gains and then you have long-term capital gains. So short-term capital gains, for the most part, that's the type of taxes you want to avoid, and that is any kind of capital gains from an investment held for 1 year or less. So let's say, for example, you bought Amazon stock and then you sold it 6 months later. Well, any capital gains you had in that 6-month period would be short-term capital gains, and you would be taxed at the same rate as your ordinary income tax. And that is always going to be higher than your long-term capital gains tax rate. So if you hold these investments for longer than 1 year, it could literally just be 366 days. Well, now it falls under the category of a long-term capital gain. And this can be a significant difference in taxes, in some cases as much as a 20% difference. And you'll also find that right now, as the current tax code is, for the lowest income brackets, the long-term capital gains tax rate is actually 0%, so you can avoid paying taxes altogether. So that's the first thing you have to understand with M1 Finance. In any brokerage out there that you invest in, you have both long-term and short-term capital gains, and there's a significant tax advantage to holding on to your investments for longer than 1 year in order to recognize long-term capital gains. Now, the other thing you have to be familiar with is the rebalancing feature of M1 Finance. And essentially what that is, that means as your portfolio gets out of whack in terms of your allocations, you can click a button and rebalance that portfolio. So let's say, for example's sake, you had a 50-50 portfolio of one stock and another stock, just two stocks, stock A and stock B. Well, let's say 6 months later, it's no longer 50-50, it's 40-60 because one is doing a lot better than the other. Well, you could rebalance that portfolio by clicking on that button to rebalance. But the issue you'd run into is you are exposing yourself to a taxable event. Because what's going to happen is the stock that you're overweight in, that you have 60% of your money in, well, they're going to sell some of that and then they're going to buy more of the other one that you're low in. And by selling, you have recognized a short-term capital gain, which is going to be taxed at the highest income level. Rather than rebalancing by clicking that button and rebalancing your portfolio, the best situation is to simply add more money to that portfolio. And as you add money, M1 Finance is going to automatically rebalance your portfolio. So understand that with the rebalancing feature is that every time you click on that button to rebalance, you could potentially be exposing yourself to short-term capital gains. So always consider that when you're doing that. And the best thing to do to avoid that is just to contribute more money that's going to automatically, they're going to try to rebalance your portfolio. Now, the other thing you're going to run into here, and again, this is going to be with any brokerage out there, is qualified versus ordinary dividends. And this is honestly quite a complicated subject here. But in a nutshell, the way it works is that with a qualified dividend, you are paying a lower tax rate. Now, I'll go ahead and read you guys the guidelines on what a qualified dividend is. And to be honest with you guys, it's even confusing to me. But what you have to understand basically is that by holding on to a dividend-paying stock for a long enough period of time, eventually, just like with long-term capital gains tax rate, you're paying a lower tax rate on what is called a qualified dividend. Okay, so this actually comes right from the M1 Finance website. I'll also link up to this article in the description below if you guys want to read this yourselves. But this is what it says on qualified dividends. To be classified as qualified dividends and be taxed at a lower dividend tax rate, they must satisfy 3 requirements. Number 1, paid by domestic corporations or qualified foreign companies that trade on the U.S. stock exchanges or are incorporated in a U.S. possession. So basically, it's a company that trades on a major U.S. exchange that pays a dividend. The second qualification must be ordinary dividends and are not capital gains distributions or dividends from tax-exempt entities, which is something you're probably not going to run into. I have seen capital gains distributions before with some of my other investments. For example, I own a utility stock, and I remember one time there was a special distribution that was because they sold off a section of their business, and it wasn't just an ordinary dividend. And then the final piece, this is where things get confusing. Met the minimum holding period requirement, which is more than 60 days during the 121-day period starting 60 days prior to the ex-dividend date for common stocks. And then for preferred stock, it's more than 90 days during the 181-day period starting 90 days before the ex-dividend date for preferred stocks. So do you really need to sit down there and calculate these dates out yourself? No, you don't. All you have to understand is that once you hold most dividend stocks long enough, you do have qualified dividends that are going to be taxed at a lower tax rate than your ordinary dividends. But anyways, guys, that wraps up this video. Those are the basics you have to understand about taxation with M1 Finance. The one thing that you really just have to watch out for is that rebalancing feature. Understanding that by doing that, you could be exposing yourself to a taxable event. If you guys do want to learn more about M1 Finance, feel free to check out that free 30-minute training linked up in the description below. And other than that, guys, that's going to wrap this up. So thanks so much for watching, and I will see you in the next video.